The investment thesis for TGS ASA centers on its transformation into the dominant, fully integrated energy data provider following the acquisition of PGS ASA. The combined entity benefits from significant, accelerated cost synergies, structural supply constraints in the seismic market that enhance pricing power, and a low-leverage financial profile capable of supporting high shareholder returns and strategic diversification into new energy markets. TGS is positioned to capture value from the multi-year cyclical recovery in offshore exploration and production (E&P) spending, while simultaneously developing critical data services for decarbonization initiatives such as carbon capture and storage. TGS ASA provides an attractive, high-yield investment vehicle for exposure to the cyclical recovery of the oil services sector, underpinned by strong financial discipline. Key risks. The primary investment risks involve sensitivity to geopolitical events that dampen global oil demand and prices, execution risks associated with fully realizing the remaining merger synergies, and the inherent capital expenditure requirements (CapEx) for the multi-client model, which can lead to impairment if licensing sales disappoint. Corporate strategy and core business model. 1.1. The Integrated Energy Data Leader, defining the new TGS ASA. TGS ASA has fundamentally redefined its competitive landscape through the successful acquisition of PGS ASA, completing the transition from a pure-play multi-client data firm to a fully integrated energy data company. This strategic move was announced in September 2023 and completed on July 1, 2024, creating an entity with a robust position across all geoscience verticals: multi-client data, seismic acquisition, advanced imaging, and new energy solutions. The rationale for this vertical integration is to enhance the value and technology offerings to clients by controlling the complete geoscience value chain. TGS now manages a vast, global, diversified multi-client data library. This library comprises over 3.1 million square kilometers of 3D seismic data, more than 6.3 million line kilometers of 2D seismic data, and approximately 9.5 million digital onshore well logs. This unparalleled data infrastructure allows TGS to provide integrated geological, seismic, and well data solutions that are crucial for energy producers to identify, evaluate, and optimize targets across the entire upstream process. For instance, in North America, TGS leverages ultra-long offset ocean bottom node (OBN) in the Gulf of Mexico to help exploration companies find new subsalt resources close to existing infrastructure. The multi-client business engine, financial mechanics, and resilience. TGS's core strength lies in its multi-client business model, which involves acquiring and processing geoscience data and subsequently licensing it repeatedly to various clients. This shared investment model inherently mitigates the high risks associated with single-client contract acquisition. The primary metric used to gauge the success and capital efficiency of the multi-client model is the sales-to-investment ratio. This ratio compares pre-funding and subsequent data sales realized against the capital invested in new data acquisition programs. TGS maintains a target sales-to-investment ratio of 2.0x. The company's ability to execute efficiently is demonstrated by the achievement of a strong pro forma ratio of 2.2x in 2024, signifying robust profitability and capital efficiency. A sales-to-investment ratio significantly above the 2.0x target indicates strong pricing power and high demand for TGS's data products. This ratio is typically high due to two key factors. First, excellent project selection allows for substantial upfront pre-funding from clients, confirming market acceptance and reducing TGS's net investment risk. Second, sustained high realization rates on legacy data sales confirm that the data library holds long-term, non-depleting intellectual property value. The company's capital is thus tied up in a growing high-margin asset base rather than depreciating physical equipment, differentiating TGS as fundamentally an energy data IP company. Furthermore, TGS de-risks its business by maintaining a geographically diverse data library focused on active, proven basins. Key investment areas include the Permian Basin, which is expected to contribute over 50% of U.S. oil production by 2026, the MSGBC Basin, and deepwater exploration regions like East Coast Canada and the Campos and Santos Basins in Brazil. The integration of PGS's acquisition capabilities provides TGS with greater control over costs, scheduling, and technology deployment, which is a structural benefit that was previously unavailable to the asset-light TGS. By controlling the seismic streamer vessels, TGS can optimize multi-client investments with greater precision, ensuring the acquisition of the right data to meet client needs. This vertical integration should further optimize the cost component of the multi-client calculation, potentially leading to future margin expansion and enhanced capital efficiency metrics. Strategic transformation, analysis of the TGS-PGS integration, merger execution and synergy capture. The combination of TGS and PGS, completed on July 1, 2024, was structured to deliver a highly complementary entity. PGS shareholders received 0.06829 shares in TGS ASA and 0.20419 in cash for every share held. The financial success of the deal is heavily predicated on the capture of planned economies of scale and cost efficiencies. The combined entity targeted substantial annual cost synergies in the range of $110 million to $130 million. TGS has a favorable track record of successful inorganic growth and integration, including previous acquisitions of Magseis, Ion, and Predictor. This experience proved valuable, enabling the company to execute an efficient integration process. The reorganization process was completed in Q3 2024, which was the first full quarter following the merger. Crucially, TGS is ahead of schedule in its synergy realization. The company realized an approximately $55 million annual run rate synergy figure during Q3 24. This rapid capture of roughly half of the targeted savings is a highly positive operational development, significantly reducing integration execution risk, which is often the highest uncertainty factor in M&A valuation. S&P Global analysts expected a smooth integration and synergies above $100 million, in line with company projections. Achieving front-loaded synergy realization accelerates the accretion of the deal and allows analysts and investors to incorporate the full synergy target into financial models sooner, providing stronger support for the stock's intrinsic valuation. TGS remains on track to deliver the total annual run rate synergies within the guided range by the end of 2025. Operational and financial upside post-integration. The merger dramatically increased the operational and financial scale of the company. TGS reported pro forma revenues exceeding USD 1.8 billion and a pro forma EBITDA of USD 961 million for 2024. In Q3 2024, the first post-merger quarter, the combined entity reported $500 million in revenue. Furthermore, the integration has led to a significant increase in future committed revenue. Order inflow for Q3 2024 reached $423 million compared to $355 million in Q3 2023. This increased inflow contributed to a substantial expansion of the firm's order backlog, which grew to $750 million at the end of Q3 24, up from $612 million at the end of Q2. The robust growth in the order backlog demonstrates strong forward demand for the newly integrated TGS-PGS offering, confirming that the combination of data library and acquisition assets resonates well with clients. A large, expanding backlog is essential for smoothing the inherent cyclical volatility of the seismic industry, providing a reliable foundation for revenue stability. This stability is necessary to justify the company's ambitious multi-client investment forecasts, which are expected to be in the range of $425 million to $475 million. The combined entity also possesses enhanced technological leadership, providing highly advanced services such as ultra-long offset OBN data acquisition and advanced imaging, which are essential for complex exploration challenges. Macroeconomic and industry dynamics. Global seismic market outlook, structural tailwinds. The operational environment for TGS is supported by strong structural tailwinds in the global energy sector. The broader oil and gas industry is projected to invest over $500 billion in exploration and production (E&P) activities by 2026, creating robust demand for seismic services necessary to accurately identify potential reserves. A particularly favorable driver for the vertically integrated TGS-PGS entity is the strong recovery in offshore E&P spending. Offshore exploration capital allocation is projected to grow at an aggressive rate of 8 to 12% annually between 2024 and 2026. As TGS now incorporates a fleet of high-capacity seismic streamer vessels and holds extensive deepwater ADA coverage in areas like the Gulf of Mexico, Campos, and Santos basins, the company is ideally positioned to capitalize on this multi-year cyclical recovery. Supply-side constraints and pricing power. The current market dynamic is characterized by a cyclical demand recovery occurring within a structurally constrained supply environment. The global seismic vessel fleet has seen a dramatic reduction, decreasing by 69% from its 2013 levels. Given that building new high-capacity vessels is a costly $200+ million and time-consuming 2 to 3 years endeavor, the reduced fleet capacity creates potential supply bottlenecks if the demand for seismic acquisition remains robust. This convergence of rising demand and constrained supply creates a highly favorable environment for TGS. As one of the few integrated players controlling both the extensive multi-client data library and the essential acquisition assets, TGS is uniquely positioned to benefit from increased vessel utilization and sustained pricing power for its services. This structural change mitigates the severe volatility historically experienced in the acquisition sector, suggesting that TGS and its few major competitors will enjoy structurally higher margins compared to past cycles. Competitive landscape. TGS competes globally with major integrated service companies such as Schlumberger N.V. and Halliburton Company, along with specialized data and technology firms like TGS ASA. Post-merger, TGS stands out as the dominant pure-play energy data specialist, integrating key capabilities that cover the entire upstream value chain. TGS offers geophysical data, seismic, geological services, digital well logs, interpretation products, and advanced imaging services, 4D time-lapse and anisotropic imaging. This comprehensive suite ensures that TGS's revenue streams are not solely dependent on volatile frontier exploration, but are also linked to continuous field development and production optimization, reservoir characterization, providing a continuous and less cyclical revenue component. TGS maintains strategic collaborations, including a partnership with Schlumberger Limited for OBN projects and an ecosystem arrangement with CGG and the former PGS, which provides shared access to subsurface multi-client data libraries. This collaborative positioning further solidifies TGS as a central and essential market platform for geoscience data. Financial health and capital allocation. 4.1 Revenue and profitability analysis. The combined entity demonstrates significant profitability and scale. Pro forma financials for 2024 showed revenues exceeding $1.8 billion, generating a pro forma EBITDA of $961 million. More recent performance confirms strong momentum, with Q3 2025 revenue reaching $388 million, representing a robust 26% increase from the previous quarter. The focus on the high-margin multi-client model, coupled with synergy realization, resulted in a strong operational performance, reflected in a Q3 2025 EBITDA margin of 62%. Despite strong recent performance, the long-term historical view shows the extreme cyclicality of the market, with the 5-year average earnings per share growth rate currently negative at -14.22%. This highlights the criticality of the post-merger period for achieving sustained earnings accretion and overcoming the historical volatility. 4.2 Balance sheet strength and leverage. A critical component of the investment thesis is the conservative leverage profile maintained by TGS, particularly after executing a major acquisition. The company's strong balance sheet is deemed essential by its board of directors for risk management during industry cyclical downturns and for financing future growth. TGS maintains remarkably low leverage ratios. A debt-to-EBITDA ratio significantly below 1 point following a major acquisition underscores the company's exceptional financial discipline and high free cash flow generation capacity. This conservative leverage profile provides TGS with substantial strategic flexibility, capacity, often referred to as dry powder, to absorb market shocks, fund delayed projects, or pursue potential further consolidation within the seismic service market. During Q3 2025, the company successfully reduced its net debt from $479 million to $432 million. Cash flow and capital management. TGS reported strong free cash flow (FCF) of $81 million in Q3 2025. Capital allocation is focused on funding the lucrative multi-client library growth. The company has forecast multi-client investments in the range of $425 million to $475 million, with approximately 70% of these investments expected to be acquired using its own resources. TGS demonstrates effective capital management agility, highlighted by a revision in CapEx guidance downward from $135 million to $110 million. Operational exposure to currency risk is minimized, as the majority of revenues and costs are denominated in USD. Shareholder returns, dividend policy. TGS is noted for returning significant capital to shareholders, reflected by an attractive annual dividend yield of 6.91%. The annual dividend amount is approximately NOK 6.46. However, analysis of the dividend history reveals a crucial nuance. While the current yield is high, the payments have been volatile and have fallen over the past 10 years, reflecting the extreme cyclicality inherent in the underlying energy industry. The volatility is masked by high recent growth rates, such as the 3-year dividend growth rate (DGR) of 53.99% and 5-year DGR of 22.22%, which represent a sharp recovery from previous cyclical lows. Management explicitly states that the cash dividend policy is tied to the company's long-term underlying cash flow. Investors must recognize that the dividend acts as a cash flow distribution mechanism rather than a commitment to stable progressive growth and is subject to E&P budget cycles. Growth vectors and decarbonization strategy. New energy solutions (NES) strategy. TGS is strategically diversifying its revenue base by leveraging its core geoscience expertise in non-hydrocarbon markets, positioning itself as a central player in the energy transition. The New Energy Solutions (NES) strategy focuses on data monetization for emerging markets rather than high-capital infrastructure deployment. This approach minimizes capital risk while maximizing the return on the company's existing data library and intellectual property. Carbon Capture and Storage (CCUS). The company is directly involved in the rapidly developing CCUS market, where geological expertise is paramount for project success. TGS has entered a collaboration with Equinor to advance the digitalization of carbon capture and storage operations. Geoscience data, including high-quality seismic and geological surveys, is essential for identifying, evaluating, and de-risking secure offshore carbon storage sites. This expertise is critical in areas like the UK continental shelf (UKC), where significant government funding and regulatory attention are focused on developing world-class geology for storage. TGS's data supports major projects such as the Bonaparte CCS project in Australia, which was granted major project status. Offshore wind and site characterization. TGS is applying its subsurface expertise to the offshore wind sector, providing vital site characterization data. This includes multi-beam and seafloor sampling (MBSS) projects. The growth of the offshore wind market, particularly in the U.S., is supported by regulatory mechanisms like long-term energy credits, which stabilize project production revenues by insulating them from market price fluctuations. This offers a more stable, less cyclical revenue stream for TGS compared to its traditional oil and gas segment, providing a valuable counter-cyclical component to the overall business mix. Investment risks and valuation. 6.1 Sectoral and geopolitical risks. TGS's core revenue base remains highly sensitive to global oil and gas E&P spending, which, in turn, is sensitive to global macroeconomic stability and geopolitical tensions. Geopolitical conflicts increase uncertainty, which negatively affects consumption and investment, acting as a global demand shock that ultimately dampens global oil demand and prices. This domino effect, known as the economic activity channel, can lead to deferred E&P budgets, negatively impacting demand for seismic services. While financial markets often have a modest reaction to geopolitical risk events, major conflicts can have disproportionately larger and more persistent effects on asset prices. TGS, through its exposure to global exploration budgets and its significant fleet of assets, is indirectly exposed to financial market volatility and increased operational risk associated with prolonged international tensions. Integration and execution risk. Despite the rapid early synergy capture, the successful realization of the full $110 million to $130 million target depends on sustained execution throughout 2025. Any delays in the integration of vessel operations, technology platforms, or overlapping general and administrative functions could cause analyst revisions and market disappointment. Furthermore, the highly capital-intensive nature of the multi-client model, with a CapEx forecast of $425 million to $475 million, presents inherent financial risk. Although TGS has maintained a robust sales-to-investment ratio of 2.2x, failure to sustain high pre-funding rates or realization sales in future projects would necessitate asset write-downs and impairments, impacting the balance sheet. Valuation comparison and analyst sentiment. TGS currently trades at a TTM price-to-earnings (PE) ratio of 15.74. When assessing enterprise value (EV), the company's extremely low debt-to-EBITDA ratio of 0.86 suggests that the company's strong earning power is not excessively leveraged, providing a safety buffer. Based on projections from 5 analysts, the average 12-month price target for TGS is 88.86 NOK, with a high estimate of 136.43 NOK and a low estimate of 70.57 NOK. Relative to a recent closing price of 93.50 NOK, the average target suggests a potential downside of negative 4.97%. This slight downside indicated by the average consensus target suggests that the market has already efficiently priced in much of the expected synergy value and the anticipated offshore market recovery. However, the investment thesis relies on the continued upward revision of analyst expectations. Given the rapid execution of synergies, $55 million run rate achieved ahead of schedule, and the strengthening order backlog, $750 million, it is highly probable that analysts will increase their consensus targets throughout 2025 as the full financial benefit of the merger is realized and as the strong offshore market growth, 8 to 12% annually, materializes. Therefore, the investment rationale is based on successful execution driving future target revisions rather than immediate undervaluation. Conclusion. TGS ASA has effectively managed a transformative acquisition, resulting in its establishment as the preeminent fully integrated energy data provider. The successful vertical integration with PGS positions TGS to control costs, benefit from structural supply constraints in the seismic market, and command robust pricing power. The rapid realization of cost synergies significantly de-risks the merger and accelerates the accretive impact on earnings. The company is capitalizing on 2 parallel trends: a sustained multi-year cyclical upturn in global offshore E&P spending, and the nascent demand for high-quality geoscience data in new energy solutions, CCUS and offshore wind. TGS's low leverage profile, debt to EBITDA 0.86, and high profitability, 62% Q3 EBITDA margin, provide financial flexibility to manage industry cyclicality while maintaining high capital returns. Targeted investor profile. The stock is particularly suitable for institutional investors and portfolio managers seeking high yield, 6.91%, combined with defensive financial metrics, low leverage, and operational exposure to both the global oil services recovery and the essential data-driven components of the energy transition. Key monitoring indicators. Continued investment in TGS should be contingent upon management meeting or exceeding the following operational thresholds. Synergy realization. Full achievement of the USD $110 million to $130 million annual cost synergy target by the end of 2025. Capital efficiency. Sustaining the multi-client sales to investment ratio above the 2.0 target. Forward visibility. Continued expansion of the order backlog beyond the $750 million reported in Q3 2024, confirming robust forward demand for the integrated service offering.